And the next big use case, because the financial system's clearly realizing that its opportunity is here and there's a race. The other one is tokenizing everything.
I'd just rather be in something that doesn't need bailouts, right? There's never been a crypto bailout. I think this is still very, very positive for.
But look at that, though, and then say, look at the rise of Bitcoin lending.
Yeah.
How do we think about this? Because, we can't help ourselves. We build leverage. Humans build leverage. Even on a 70-vol asset, we're going to build leverage. And how do you think about that versus the kind of fractional reserve banking system or the inherent leverage in the banking system?
Hey guys, welcome to Everyday Finance. Raoul Pal examines the most recent turning moment in the history of Bitcoin, where market structure and macro forces meet. Bitcoin is currently trading close to $114,000, challenging strong resistance at $115,000, following a steep 10% increase from $103,500. Analysts caution that maintaining the $114,000 level is essential to determining whether this recovery is truly sustainable. This week, according to Swissblock, it's all about confirmation, demonstrating that Bitcoin can provide a solid foundation for the subsequent step higher. For long-term bullish momentum, experts like Rec Capital and On Crypto Trades stress that staying above the 200-day moving average is crucial. But beneath the surface, cracks are starting to show. Investor caution is evident from the fact that trading volumes have decreased by more than 17% in the last week, and that on-chain participation is still low. However, Glassnode claims that the market may be coiling for another breakout as the selling pressure has subsided. Bitcoin may break past $115,000 and reach new heights if spot volumes increase and demand widens. The tone is currently one of cautious optimism. Bulls are in charge, but conviction is still being put to the test.
It's really interesting because back when I discovered Bitcoin 2012 via Chad Cascarilla and Emil Woods, I was trying to start the world's safest bank with a bunch of global macro investor subscribers, a bunch of family offices and stuff. And we had the chairman of the FDIC, the ex-chairman of the FDIC as the chairman. We found a Texas Trust Bank, and it was going to be a bank that just put its deposits 1-for-1 at the Fed. Yeah. Basically a stable coin, right?
Yeah.
And we went to see the Dallas Fed, and they went, "This is amazing. This is such a good idea because this is just what the system needs." And we were like, "Fantastic." He said, "We'll never give you a license."
Why?
I'm like, "Why?" He's like, "Because you're going to take all the deposits from the banking system." And so here they've actually done it. Right now, they don't pay interest, but they will.
Yeah.
And they'll figure out the ways to pay interest. And, in the end, what they feared the most is what has happened, which is people don't want the leverage of the financial system. That's what we've been trying to solve all along.
Oh, yeah. And, let's be honest, it hasn't served them well, right? Like you get zero on your deposits at a bank and they blow up every, 20 years. And remember, hey, that's literally in the Genesis block of Bitcoin. Satoshi was so pissed that there was another 50 billion pound bailout of a bank that Satoshi created a 300 million person movement, right? And they throw 50 billion around in days these days. That's like nothing. Like whatever made Satoshi pissed is tiny. They're doing trillions of bailouts now. So, it's funny. You go to a crypto conference and you talk about fractional reserve lending, they'll call security and drag you out. But that's because you're a crazy person. That's what banks are, right? And again, harking back to that SVB weekend, we got all our portfolio companies together and we were just triaging whether anybody, had any risk or, anything bad going on. And there were, most of the companies were fine, but there were a couple that had literally all their money at that bank, right? And it was Sunday and everyone's freaking out, how are we going to make payroll? How are we going to do this? Because our money's locked and the FDIC's got it. Treasury Secretary's not going to move the money, all that. I'm like, Bitcoin, you don't need Janet Yellen's permission to send people their payroll in Bitcoin, right? And that day, USDC traded 87 cents on the dollar. And it was so visceral to me. I was like, I would so much rather own USDC right now than have a deposit in a defunct bank. And that point being fully backed by treasuries is always going to be better, right?
I was in Europe in 2012, the European sovereign crisis, when the banking system went under in Europe. And people forget, this was why I went down the entire journey, because the Cyprus banking system. They took all of the deposits from the banks and bailed them in.
Yeah.
So as opposed to the government bailing them out, everybody in the country who had deposits got wiped out. It's like, holy shit, you don't own your money in a bank, and nobody in the financial systems own anything either, because it's all hyper leveraged and rehypothecated. And at that point, when you realize, okay, this game is not good.
Yeah, and I think that the typical investor in the United States and the 13 other countries that have never expressly defaulted in history kind of think they always get bailed out, right? Like banks go under, the government always bails you out. But the trajectory of everything we're seeing, there's going to be a time when the U.S. doesn't have that kind of money, right? Like they can't just bail you out. So, I'd just rather be in something that doesn't need bailouts, right? There's never been a crypto bailout. So, I think this is still very, very positive for.
But look at that, though, and then look at the rise of Bitcoin lending.
Yeah.
How do we think about this? Because, we can't help ourselves. We build leverage. Humans build leverage. Even on a 70 vol asset, we're going to build leverage. And how do you think about that versus the kind of fractional reserve banking system or the inherent leverage in the banking system?
Oh, yeah. I hear you that, speculation drives, more speculation. And so some people do use crypto to speculate on crypto. But I think it's a very small fraction of the industry. Most people just buy it as a, store wealth or, for other reasons. Whereas the entire banking system's built on leverage. And one of our big investors is a big bank and invited me in to talk to their executive board. And they said, well, won't this impact bank deposits and then ultimately, corporate leverage? I was like, yes, there's no other answer. And so I do think you're going to have a world, and again, this is 10 years from now, so I'm not saying it's going to happen overnight, where a whole generation of people is going to grow up saving in stablecoins, right? There's going to be a whole generation of young people that just think, of course, you have a digital wallet on your phone, you save in a stablecoin. And there are ones like Mike Cagney's Figure already has Yields out there, which is a yield-bearing stablecoin, right? And so there'll be a whole generation of people that go, oh, I just keep my excess savings in Yields, right? Because it's giving me interest. So you're going to have that whole thing. And then with banks losing those deposits to stablecoins, which they've already lost $300 billion to stablecoins, and there's only 17 trillion of bank deposits, right? Like it's not zero, it's small, but it's starting to be meaningful. You're going to end up, I think, with a world where what banks used to do is replaced by stablecoins and non-bank lending, right? So the leverage that will have to be there will be in other non-bank alternatives, and the spread will be wider. I think that's the reality is, banks take $1 in, they lever it up 13 times and loan $13 out, right? If stablecoins don't have any leverage, the yield on treasuries will, all things being equal, go lower, and then leverage will be expensive. And so these non-bank lenders will be lending at much wider spreads.
Pal places these transient price conflicts in the broader framework. He contends that stablecoins' meteoric rise is the cornerstone of a new global. It's a financial system rather than just a crypto invention. Stablecoins are subtly emerging as the mainstays of contemporary trade, enabling decentralized finance, cross-border payments, and real-time settlement as liquidity shifts toward digital dollars and programmable assets. According to Pal, this change makes it harder to distinguish between blockchain and traditional banking, changing how credit is extended, how capital moves, and eventually how monetary policy works. According to this theory, Bitcoin is developing into the hard reserve layer that sits atop a developing digital economy, not just a speculative asset.
And we will definitely build kind of a DeFi stack on top of stablecoins. So, I was speaking to somebody, and even the Treasury's thinking, how do we get lending markets into emerging markets in dollars to spread the dollar? Because Scott Besson, again, he's saying this stablecoin market is going to go to 3 trillion within whatever few years, which is a big chunk of the 17 trillion, as you said. And it's like, well, if we can then get foreigners to be doing their borrowing and lending on an app on top of stablecoins, it's a very big deal.
No, I totally agree. And I agree the current administration's spot on. It is in the United States' interest to promote stablecoins because 99.6% of them are backed by U.S. Treasuries. So it is very good. It's unambiguously good for the United States to have stablecoins be popular.
And the next big use case, because the financial system's clearly realizing that its opportunity is here and there's a race. The other one is tokenizing everything. And that seems a big deal. It's like NASDAQ and I mean, everybody's looking at this now and figuring it out. Robin Hood's, moving at lightning speed on this. How do you think about that trend?
Yeah. So, you and I agree that blockchain is going to change the world, but it's not going to change it overnight. And your statement of tokenizing everything, I would say maybe not quickly, And so there's a great, I'm on the board of Figure, and Mike Cagney's super brilliant guy. And
I love Mike. He's a great guy.
Well. He said, and he's the biggest tokenized real world asset entity out there. It takes homogeneity and ubiquity to want to be on the blockchain. And that is a great way to say it. Treasuries are the ultimate homogeneous product. Like you do not care if you have the 3 3/4 of 2036 versus the 4 7/8 of whatever. You couldn't care less. And they're ubiquitous. Everybody on earth needs access to US dollars and probably would like interest. So US treasuries are great. And we're investing in a protocol called Ondo that does that. They already have, I think, 12 billion of that. Great use case, right? But we've invested in things to where we were a bit early, where we were trying to do like commercial real estate on the blockchain. Apparently they're illiquid for other reasons than they're not on a blockchain. That there's a reason commercial real estate's not on the blockchain yet. So what I would say is, although in the fullness of time, everything will be on the blockchain, treasuries, US dollars, like stablecoins definitely want to be on the blockchain. And as long as the US SEC wants stocks to be on the blockchain, it'd be great to have them on the blockchain.
Yeah, because I think if you think about, again, the US's strategic policy, having stocks on chain means that everybody in the world can invest in Tesla and Apple and whatever, right? Yeah. It's instant access to everybody. It's impossible, near impossible if you're in India or the Philippines or whatever, to buy the world's greatest companies. You can't do it. But this suddenly will have access to everybody. So it just opens up the US capital markets to everybody, and the sucking in of capital is going to be huge, and that's how you service the debt.
Yeah, and I was spot on that. We've had really kind of primordial versions of that. We've had American depository receipts, global depository receipts, and they kind of work, and like wealthy people in a couple countries can access those. But you're right, a 20-year-old in India probably doesn't have access to a GDR, right? And they can't buy Apple. And so, yeah, it seems self-evident that it'd be great to help raise capital to U.S.-based companies. And so tokenized equity seems like a very good way to let U.S. companies raise capital. And again, the other half of this that people don't talk enough about, financial inclusion, right? Why can't that 20-year-old guy in India get to buy Apple stock? Apple stock's been going up for 25 years, right? It'd be great if that person could actually participate in the capital formation that's making other people wealthy, right? So I just don't see why either side shouldn't want this to happen. We want to raise more capital for companies, and then we want to let more people invest.
But if you are India, you're going to be nervous because capital flight. Because essentially, A, the rupee doesn't do well over time. And B, there is capital restrictions of how much money you can get out. But these rails help people get around that. And before you know it, Indian wages are being spent on US companies and buying US debt.
Yeah, and so that's why I only focus on the United States SEC, who should be wholly for this. And yes, you're right. There are a lot of companies that want to, prohibit their citizens from participating in the world's economy.
Difficult.
That's probably great for them, right? Because they can save in a better vehicle, they can get better returns, then they can potentially buy more.
So the money will flow that way. It's decentralized. It's permissionless. In the end, people will still do it. It's hard to stop, is the point.
Yeah, no, and I agree. And it has been great, right? Like the internet being, again, a great example. A bunch of countries used to repress information, and their citizens had no idea what was going on in the world. And as they learn more about the world, they can get a higher education. They can, invest in things, So it is coming, that people will have access to the world's capital markets. And the beauty of that is 4 billion people have a smartphone, and that's the only thing it takes to operate Bitcoin.
In addition to Bitcoin, The market is paying attention to Solana's comeback. The Bitwise Solana staking ETF, ticker BSOL. The first Solana ETF established in the United States has sparked excitement in the cryptocurrency community. In addition to direct exposure to Solana, the fund offers staking incentives of about 7% each year, which is a significant milestone for widespread adoption. Institutional interest is growing. JP Morgan predicts $3 to $6 billion in inflows within the first year, while Bloomberg's Eric Belhunas reveals that Grayscale's Solana Trust is scheduled to convert into a spot ETF. Technically speaking, Solana's chart displays a robust bull flag formation, which frequently comes before significant continuation rallies. Analysts predict that a breakout above $25 might push SOL into $400 or higher. Given that prices are now trading around $23 and momentum indications are getting stronger, volume is increasing, confidence is growing, and Solana's largest rally too far may be imminent.